Hello, welcome to Accounting Hub. I'm Professor George Scarpin, PhD in accounting, and our topic today is purchase discounts. Purchase discount represents reduction in the amount to be paid by the buyer if remittance is made within a designated period of time. For instance, 2/10 and/30 means a 2% discount if paid within 10 days, otherwise full payment within 30 days and recorded by either gross method or net method. The recording is quite similar to sales discounts. And we have a video about sales discount, and the video is in our video description. So let's go to our Excel file, and all our Excel files, they are free to download it, and the link is also in our video description. So let's delete it here and let's do it together. First of all, the gross method. We record the discount only when we pay it. So, what do we have it? On April 19, Skyping Corporations purchased $80,000 of inventory and is offering a discount of 4% for any amount paid within 10 days. And the full invoice is due within 30 days. Scarping paid for $43,200. That is 45,000 less the 4% cash discount on April 28th, so during the discount period, and the remaining balance was paid on May 15th. And we employ a payroll inventory system. And what is this info important? Only to record it in the inventory account instead of the purchase account. So, okay, let's work with the gross method first. April 19th, purchase $80,000. So, debit inventory 80,000, credit accounts payable $80,000. Okay, so let's go. April 28th, we paid 43.2. So this is our cash, $43,200. However, we are paying 45. The difference is our discount. However, where do we record our discount? We record it on inventory. Why? Because inventory, we work with the net purchase, and net purchase is purchase plus uh, shipping and less discount. So we should record the discount crediting the inventory. How much? The difference between both. $1,800. And let's do it here. Wow, I'm doing it now. So that is why almost live video is interesting. So let's work with the inventory here. So inventory debit was method 80,000 on April 19th and credits 1,800 on April 28th. So here, oh, and okay. So $78,200. And on May 15th here, we pay the remaining balance. So we pay the 35. So 35 accounts payable, 35 cash. Okay, so let's work now with the net method. Net method, we record the net value. So we record the 80,000 uh, less 80,000 times 4%. So we record 76.8. And then accounts payable. So the inventory here will be 76 on April 19th. Net method. So we are recording it by the net number. So we have no other no three accounts in our journal entry. Only two. We are deducting accounts payable 43.2 and cash 43.2. Okay, and what about the net method for the full payment? We pay cash 35. Oh, that is not 35. Oh, yes. We pay here cash 35. However, the accounts payable, we are working with the net numbers. So how much? 35 less 35 times 4%. So net value, we always work with the gross value less discount. And then purchase discount loss, we work uh, with the difference here. That is a debit of 1,400. So let's make it more beautiful, guys. Oh, cut. Yes, now it is the same as uh, your Excel file. And what is that this purchase discount loss here? We add it on inventory later. So when we add it to on inventory, we have the inventory, the gross inventory will be 76 plus 1,400. Okay, guys? So this is an inventory account. So, guys, this is not so hard, quite similar to sales discount. The only difference is we have no expense or revenue here. We work with the inventory. Okay, guys, thank you so much. Subscribe our channel. You will be the first one to know when a new video arrives. Like our Facebook page, Accounting Hub by Dr. Scarping. Like this video. And if you have questions or comments, leave it here or email me at jscarping@gmail.com. Have a very nice day.